The Honest Money podcast is brought to you by Prescient Investment Management. We consider everything to give you the advantage. It's the future of investing. Prescient Investment Management is an authorized FSP.
Welcome to Honest Money. We are doing questions and answers, and today's a nice one because it's somebody that's got car debt. It's around about. They didn't give us their name. I'd love it if you just send your name so we can kind of shout out to you when you're asking us these questions. So this is someone who's got car debt of about 260,000 rand. The interest they pay on their car debt is prime plus 1. I think prime plus 1.1 or something. It doesn't matter. It's prime plus 1. And they're getting a bonus. And the question for themselves is, do they take that bonus and settle the debt? Do they take the bonus and invest it in their RA, or do they take the bonus, invest it elsewhere, and then just keep going on the car repayments, the RA, and see what happens? So let's just talk through your kind of choices and your avenues here, because I think it is a great question, and maybe just explain the principles to get to an answer. So for me, I think understanding that, taking a portion of your bonus and putting it into your RA makes a lot of sense. Number one, because you reduce the tax that you're going to pay on your bonus. In effect, SARS gives you a portion of that repayment into your RA as kind of a kickback on your taxes. So I mean, we all need to pay tax, but we don't have to pay more than we want, right? So if you can pay a bit less tax, actually, and build up your long-term retirement savings, that's a great idea. I have no problem with that. However, you need to compare that with what else you can do with the money. Now, when I look at a debt on a car of prime plus 1, currently prime is over 11%. So if you're paying prime plus 1, you're paying more than 12% a year. Now, when we look at the world of investments, it's impossible to find a 5-year investment that guarantees you a tax-free return of 12% a year or more. You can invest in the stock market, and as we know, the stock market, if you take a 5-year view, it's very unlikely that you will lose money, but equally, it's not guaranteed that you will make 12% a year. And certainly, the growth that you make from the stock market, while it can be very good, it's not going to be tax-free. Somewhere along the line, one day you're going to pay probably capital gains tax. So looking at your car debt, I look at it and say, well, if I can pay extra money into my car debt, that means that I'm getting the equivalent of a return, a guaranteed return of 12 whatever percent tax-free, because you're actually saving the interest. So that for me is a guaranteed return. So I'm landing on the answer, and the answer is take the money, put it into your car, get that debt down as much as you possibly can. If you've got it paid off, that's even better. If you're now in a position where you don't owe anything, then you take that monthly amount that you were earning, not that you were earning, but that you were paying into the car, and you divide it. So you put a portion into your retirement fund. If you haven't maxed out your tax-free savings account, that's a no-brainer. Please do that, max out your tax-free savings, and then you can keep adding to a, kind of an exchange-traded fund or a unit trust, something that will give you, long-term capital growth. So I think that, using the monthly repayment is key here. If you take the bonus, you pay it off into your car, your car debt, and then you just take that monthly amount that you were paying into the car and just blow it, then you've wasted your time and our time recording the show for you. So please don't do that. What you need to do is use that savings to kind of give yourself a leg up. And that's for your future self. And I think also just understanding now, the next time you buy a car, this is important. You should not be in a position where you're financing a car at kind of 12 or 13% a year. I mean, that, if you think about the way that money compounds, what that means is if you've paid 200,000 Rand for the car, you're probably going to, over a 5-year period, almost pay another 200,000 Rand in interest. That's killer. That's wealth destruction. You cannot do that again. So I think what you do is you start building up some money now, that extra monthly amount that you've got from the car repayments, put that into a unit trust, and that's your car fund. So when the time comes for you to actually buy another car, obviously you're going to take a long time before you change cars, because now you've got a paid off car. That's a valuable thing, right? You don't just chop and change, every 3 or 5 years because everyone else is doing it. You want to get to financial freedom, I'm assuming. So hold the car for as long as the car is safe to drive. As long as doesn't matter if the car costs you, 20,000 Rand a year in services, that's much cheaper than paying 5,000 Rand a month on a car repayment. So don't worry too much about that. Make sure the car is safe, make sure it's well serviced, and then use a monthly amount to build up a lump sum that you can put down to buy a car in the future. So when you trade in your current car, you use that trade-in value plus your top-up cash that you've been building, and you pay for the car cash. That's the way to buy cars when you've got to the position of a paid-off car. Take your time, build up capital, and buy the cars cash. And don't listen to all the people that tell you that, there's a tax advantage, if you've got commission or whatever it is, you can get a salary structure. All of that stuff's garbage. What's actually happening is you're paying the banks 13% a year to lend you money on something that's going to depreciate in value. Cars are not an investment. They could be an income generator. I understand that. But other than that, they lose you money. And yes, you feel good when you buy the car, but after that, you feel bad every single month when you're paying the blooming thing off. So don't do that. Build up that lump sum, get to the position where you buy your cars cash. The only time it makes sense for me to finance a car, and certainly I've done that in the past, I've spoken about it on the podcasts and on radio shows, is when finance companies or car manufacturers are desperate to sell cars, and they come to you and they say, we'll sell you a car at prime -5. I like that. For me, that's exciting because when interest rates are low, let's say, the last time I did this, interest rates were about 7%, and the car companies were in the middle of COVID, desperate to sell cars, so they were offering prime -5. So that meant I was paying kind of just a bit less than 2% a year on interest. I'm happy to pay 2% a year on interest and rather invest the balance of my money in capital growth that should give me at least 10% a year, even if it's not guaranteed, even if I have to pay a bit of capital gains tax. So use the car companies to your advantage. When they're desperate, that means they're offering you great deals. So don't pay up for the car if they're offering you a good finance deal. You still got to pay a low price for the car, but pay a good price, finance the car very cheaply, and that makes sense. Other than that, negotiate with cash. Negotiate with the money you've got in your bank account when you're buying a car. Don't go and get a good finance deal. And especially don't finance cars over 6 or 7 years now. The interest costs are enormous. And affordability is not what you're paying on a monthly basis. It's what actually happens to your financial position over decades when you keep buying new cars, keep making the financiers rich, and the shareholders who kind of own those financiers, they love you. So people like me who buy indexed investments, we love people who kind of borrow money. Why? Because our indexes own banks, and banks make a lot of money out of people doing that. So what you need to do is be a shareholder, not a kind of a client of a financier. I hope that helps. Keep sending your questions. We really appreciate them and look forward to many more in the future. Thank you so much.
The Honest Money podcast is brought to you by Prescient Investment Management. We consider everything to give you the advantage. It's the future of investing. Prescient Investment Management is an authorized FSP.